Oh, we have Bashar. Are you seeing the chat?
Yes, I am.
Yeah.
Yes, I'm so happy. You can see the smile. Let me know when you want me to start.
Yeah. Yeah, maybe just 1 or 2 minutes. 1 minute, maybe we can start. Shall we start, Bashar?
Yes, so welcome everybody to this very exciting session on finance for founders. We're all here for business, so it's very important to understand the basics and foundations of finance. And whatever you do, if you're not managing your numbers and finances, you're probably not going to get too far. So welcome to this extremely important session. And welcome. My name is Bashar Kilani. I'm the president of Thai Dubai. And I'm very pleased to welcome you to another one of these virtual sessions that we're having this summer. Some of us are in Dubai, some of us are not. And I'm so happy to see on the chat people from India, from Iraq, from Egypt, from Dubai, of course. Last session, we had people from the US and Europe. I'm sure we will have people from all over the world. So please, wherever you are, don't be shy, get on the chat and tell us where you are joining us today from. I think as we move into the digital world, these virtual events are becoming very, very interesting, and people are really engaging, sharing experiences, and enabling a very good platform for exchange of knowledge and expertise. Let me say a couple of words about Thai. Most of you know what Thai is, but this is a global network of entrepreneurs. I would argue it's probably the largest or one of the largest globally, founded in San Francisco in the 90s. So a huge heritage here. And in Dubai, we've been here since 2003. Uh, very successful in the UAE, but we're also covering the region out of Dubai with a lot of focus on mentoring. There's a lot of engagement in our mentorship program. It's probably one of the best in the region, getting founders and experienced mentors to engage. I found it, for me as a mentor, a very rewarding experience. I learned a lot from these founders, and I hope I was able to share some of my knowledge and experience with them. This is all about networking, um, getting founders to network amongst themselves, but also with experienced mentors. You know, business is all about networking, and I found that the biggest value, at least for me, from Thai was the great network of charter members, but also all these founders and people that we're working to. Education. Today, we're in one of these great education sessions. We've got two great hosts today to really help us understand the topic. And I'm really looking forward to engaging with them in a very fruitful conversation. And of course, funding and incubation. Let me also at this point introduce some of my colleagues, one of our up and coming charter members, Carlina, who will tell us about some of the programs that we're running uh, in the Middle East. So, Carlina, over to you to tell us about the women and university programs.
Thank you, Bashar. So indeed, Carlina Marani, and as Bashar said, everybody's everywhere. So I'm sitting in Holland at the moment. But this year I have the privilege to co-lead the Thai Women MENA program, where we support female startups. So it's a competition for female startups across the MENA region. We're in its sixth year at the moment. And we do this across five specific regions, UAE, where we have both expats and Emirati, Saudi, Egypt, and the rest of MENA. where we indeed have the possibility for female startups to compete for equity-free cash. As Bashar said, I think the most important part of this program is that they will get a mentor that will help them. We also help through events like this, both online and physical, to make sure that they get really good at their pitch, they understand their financials, and they take their startups a step further than they were. And then, of course, they can first within the MENA region pitch a GITEX, and then the winners of the different regions will go to the finals that this year are in Jaipur, beginning of January, where they can then win the full competition and win a $50K. So it's a really good community of females globally, which gives a lot of exposure. Except for the Thai Women MENA program, 1 year older is the Thai U program, which is also kind of helping startups, but then university students. So university students in each stage of their learning path, where we also kind of help them get from innovative ideas to real business ideas and real startups. So those are the main two programs we run, and it's a privilege to be a part of it. It's really nice to help people and to see. I've now seen a few of the pitches of the female startups this year, and there's really, really good quality in there. So happy to be part of this. Handing over to our rock star, Cicely.
Thank you. Thank you. I want to acknowledge I'm surrounded by rock stars. Yeah, so my absolute pleasure to be here. We've been actually getting a lot of great response for our webinar format. We do a lot of in-person events, but we actually wanted to take it out to the rest of the region. So we've been having good responses. So do keep telling us in the chat how effective it is for you as founders sitting across. We'd be happy to take that feedback and build continuously for you. So our next event, I just want to share that we have something, again, for startups, especially the ones who have a potential to scale, to understand the power of ESOPs, where you don't have the funds to actually hire really great people, but unlocking the power of ESOPs to get in good core people on your team. This is going to be done by Karta. Karta is an amazing platform that helps founders for equity. A lot of 65% of the global startups are on the Karta platform who have fundraised. So they have a lot of insights and a lot of knowledge. So make sure you scan now and register for the event. This is a webinar as well. Yeah. And then to today's session, oh yeah, sorry. We have a community, a WhatsApp community. Please join us. We share the events there and what's coming next. And also chat to us so that we can learn from you on what is relevant for you. Please feel free to scan the QR code and join the community. We'd love to have people from all over there. And for today's session, so we're going to deep dive into the finances. We see a lot of founders, very passionate people who knows what to do with their product growth and product optimization, market planning, but sometimes their finances are not really looked into from the core at the deep level. So this session between Sala and Haitham should help you make sure that you have your core set. So wherever you're sort of building from, you can make sure that this session helps you. And please make sure you keep it interactive. ask both of them questions and, your specific queries. We will have a section at the end, but also feel free to add it on Q&A or chat. We'll try to pick out from both. Salah is, like I just learned what is FP&A today, financial planning and analysis. So he's quite a deep diver and expert in this, very passionate about working with founders and startups. And he will take us through the presentation, and Haitham will keep it conversational. We can shift. Yeah, he's quite the leader and make sure that your scale is happening, right? Once your core is set, and you make sure that the scale is happening. So these are their profiles. So they're deep down financial guys. So make sure you trouble them and get all the information you want from them. I think somebody wanted the WhatsApp QR code so that they can join the community. But I don't want to take more time, and we can just really start and then get into Q&A towards the end.
If you want to share the WhatsApp QR briefly, and then we'll move directly to the presentation.
Somebody was asking for the...
Yeah, please. So we start the countdown.
We have some regulars here as well. I see we have people from LA, from Syria, Dubai, Iraq, Egypt, Lebanon, India,
Yemen, India, UAE, everywhere.
Yeah. And India is huge. So there's different parts. UK. Yeah.
I think we can move now.
Shift to the
Salah.
Okay, hello everyone. My name is Salah Hashami, and with my colleague Haitham, we will help you startup understand the one thing that often get ignored, which is the number. So today we will fix everything and we will start this presentation. I just want everybody before we start, like, to imagine that you're building your startup company, your passion. You are working all day, long nights, but one day you don't have any cash more. So this is the story that I often see with every startup. You have a brilliant founder, a strong idea, but an avoidable mistake that you need to fix. This is today's roadmap. We will go on some major topics, from why you need to understand your finance, to metrics, to understanding the finance and overall, and to know your investment and the type of investment that you need. We will try to keep it simple and real, because in the end, this is a founder focused, not an accounting focused. Starting on. So why should founder even care about finance or even understand finance? Let me share a quick story so we could start. Let's say there is a founder that raised a fund. She was so focused on growth only. She didn't realize that her burn rate was unsustainable. After a couple of months, there was no money. It has gone, and she hadn't built anything investable yet. So you need to know your finance, because it will make you make a better decisions. That's not also, you will have to build a credibility with your investors. When you have a high credibility with them, they will trust you more, and you will have an easy life with them. And also, it will help you to survive and adapt. There is many changes, many risks in the future that you need to consider, so it will help you there. And the final say, a finance isn't just about spreadsheets. It's about control. Metrics. Okay, so now everybody will start asking, what is metrics? Well, metrics, they are number, ratio, or any criteria that will help you run and grow your business. You need to keep a track on them, maybe on a weekly basis, on a monthly basis, so you will know how healthy your company is right now. Think of these metrics as your dashboard while you are driving your startup. So you will start with our basic startup metrics. At first, there is our huge and major and most important metrics there, which is the burn rate. The burn rate is how much we are spending in cash each month. So you start your startup, you're spending each month, the total value you spend that month, it's your burn rate. That will help you or help us in our next metrics, which is the runway. What is the runway? It's how much month you as a startup can operate before it will extinguish your cash reserve. So how you find that? You easily just have your cash reserve and divide it by the previous metrics, which is the burn rate. And finally, we will have the gross contribute margin. It's easy metric, and I'm sure everyone know about it. It's just only revenue minus your cost of goods sold. But there is huge tips that everybody needs to know. This margin always, and I say always and the must, it need to be positive because it's always direct to your profitability. So the higher it is, the more profit you will get.
One question, Salah, here. Sorry, on the burn rate. When we talk about the burn rate, are we talking about only the expenses or we're talking about the net flow? Basically, if you are making some revenue at the beginning, do you deduct these revenues from the expenses to get the burn rate?
Okay, that's a good question, Nathan. There is two metrics for the burn rate. We have a gross burn rate and the net burn rate. The gross burn rate is only the cash out and the spending that you spend each month. By that, you will find how much you pay or how much you spend each month. And contrarily, we have also the net burn rate. The net burn rate is the health of your company each month. So you will deduct your cash in or your revenue from that gross margin. In some company or some industry, it's really a good indication, but in other, and when I say other industry, the one-time revenue industry, it will have like some issue by it, some fluctuation, and some cycle on it.
Another question, I think we'll come to that later in the slide. What if you don't have money left in your savings? That's something that we'll talk about in terms of investors types of investment. If you bear with us a few minutes, we'll get to that. Yes, carry on, please, Salah.
Okay. So I think everyone eager to know everything now. Okay, so we could move on and we will get to that point later in our presentation. So for next, we will need, most importantly, to understand the difference between our fixed cost and variable cost. Fixed cost, it's fixed in nature. It doesn't change even if your sales volume increase. And contrarily, your variable cost will change as your direct sales increase. We have some like example about it. We have in fixed cost, have rent, salary, etc. Also in variable cost, we have some examples that you can see. I want to share like,
one thing here to note down. We mentioned depreciation, although it's a non-cash transaction, does not affect your cash burn or cash flow, but it's part of the costing when you think of the costing. However, when you look at your burn rate, you will need to consider deducting from your cash what are the capital expenditures, like if you want to buy a machine, if you want to buy a car, if you want to buy fixed assets, long-term assets. The cost of these assets, normally from an accounting term, we allocate the cost over different periods. But at the same time, from cash flow point of view, it affects your cash immediately today. Go ahead, Salah.
Yeah, it's a good point, Ethan. So we will go back to fixed and variable cost. Why it's very important? Well, I'll give you an example about it so you understand it. Let's have an example about the founder that was expanding too fast without realizing that 70% or 80% of his cost is a fixed cost. Now he got some hiccup, his revenue dipped, and his volume of sales has declined. By that, she couldn't cut fast enough to go to normal. So you need to have like a combination between both of them to keep your company healthy and you're financially healthy as possible as you can. Well, those all the startup metrics and the basic metrics, but I need everyone to understand that they are not all the metrics that they are there. There is also an industry specific metrics that every startup need to dig and find what those industry specific metrics, and he need like to visualize them, to calculate them, and keep track on them. We will have an example of a SaaS company specific metrics.
Can we go back one step, please, Salah?
Yeah.
On the variable cost, it's extremely important to understand this part, by the way. Why do we say it's extremely important to understand it? It will define later on what is the contribution of your product. When we say the contribution, it's basically how much money are you generating from this service or this product, and what is the directly associated costs with that service or product. So a healthy position will be to have your revenues or your income more than your variable costs. So which will define this is basically your contribution, your margin to the product. So it's a name. The name of the game will be volumes. Once you have more volumes, more product or more services rendered to the customers, then you will be able to cover your fixed cost. And once you cover your fixed cost, you will be moving to profitability. So I hope that this is clear to everyone, this concept of contribution or the concept of the margin, because it does have an impact on your financials at the end of the day, on your sustainability of the business, and moving forward. When you want to tell a story to the investors, you do have a story. The healthier the margins that you have, the better story you can tell to your investors, and the faster you can recover your fixed cost, plus you can turn to profitability, making money. The business will start making money. Hope that this is clear. The burn rate, we can share the equation for burn rate. I think Salah mentioned that. Can you mention the equation for the burn rate, Salah, one more time?
Okay, so we have two equations. If it's gross burn, it will be all the cash out or spending that you have at specific month. And for the net burn, it would be the same thing, but you will deduct from it any cash in that you have each month in the same month. I hope
And
that's
runway, I think if we mix this with the runway, it will be clearer to everybody.
Yeah, well, the runway now, let's say you have an X amount in your bank at this moment. So when we like divide this amount by your gross burn, you will know, or net burn, you will know how much month you will have until you extinguish that cash. So you will, let's say, like have an example. We have a gross burn of 1K. You have like 1 million. So you will have 10 months in runway until all that cash has expended. Okay, so we could move on again to our industry specific metrics, and an example of it, a SaaS company. What's a SaaS company? Well, we have a summary about it. It's a subscription module company that you subscribe in it. We have many examples like Shopify, Netflix, all of that is a SaaS company. Those are major metrics in them that they keep track on. We will have the customer acquisition cost at first, which is a CAC. What's the CAC? It's how much expense you spend to acquire one new customer. We also have the customer lifetime value. It's how much a specific customer stay with you based on month. So we will have like an example. You have a customer that spend each month $10. He stayed with you for 10 months. So in total, your customer lifetime value is 100. Also, we have the ratio of LTV to CAC, which is the LTV divided by the CAC ratio, which we previously calculate. And the quick tips about any individual startup or founder that are managing a SaaS company or want a SaaS company, a 3-to-1 ratio is a good ratio and the high ratio and the preferred ratio by the investors. Next, we will move on a churn rate. Churn rate is a percentage of how much customer leave you over a specific time. You need to keep track on it. You need to have it as low as possible. We could have an example. You could say sometimes there's a founder think he is growing and his customer base is increasing too much, but his churn rate is 13% or 40%. In reality, when you dig deep in it, you will find that they are only replacing their lost clients. So they are not scaling. So you need to dig deep, find why your customer are churning, try to reverse it and accrue the customer and keep them with you as long as possible. Also, we have the annual contract value, which is this ACV, because every SaaS company have a commitment of 1 year. Maybe it's payment, a yearly payment or a monthly payment, but in the end, you need a revenue-based, which you need to calculate each month based on our ACV or our annual contract value.
So here, if we are telling a story, when you think of finance, it's not just numbers. Finance is a reflection of your business. It's a reflection of your customer, acquiring your customer, the cost of acquiring your customer, how long does the customer spend with you, how long does it take them to leave you, and so on. So think of finance as being your business. It's a reflection of the transactions that you do on a daily basis and the interactions that you do with your suppliers, your vendors, and your customers and employees as well, all of the stakeholders in the company, and definitely the investors at one point of time. Okay, how do we calculate lifetime value for a newly launched product, i.e. if X customers are returned, how do you predict their churn for a newly established? So the churn rate, how do you calculate the churn rate? This is the question, if you want to answer, Salah, or?
Yeah, sure. Okay. So the churn rate is basically, let's say in a specific month, you have a balance of a company or an overall company of like 100. And in a specific month in the future, like 10 customers have churn or leave you. So basically the churn rate would be those 10 customers that leave you in that month divided by the beginning balance customer on that same month. So it will be like a 10% ratio, which is 10 divided by 100.
So if it's a newly established business, it's only the first month where you will have a problem. But if you ask me, I'll take the average number of subscribers during the month. This is the way telcos operator do it. For example, they take the average subscribers for the month, which means how many customers did I have at the beginning of the month? How many customers did I have at the end of the month? The average is basically adding both of them divided by 2. And then you take how many customers left us. So you divide the number of customers who left you over the average balance of the customers. So that's another way of calculating the churn rate. And even if it's a newly established business, the more you move in the business, the more you'll get better visibility on the churn rate, and you can annualize the churn rate. There was, what is the, okay, CAC. CAC includes, and CAC includes only sales and marketing, or it should include implementation cost as well. The customer acquisition cost. Does it include the implementation? I assume the implementation here, you mean the development, software development cost. If this is the question, do we include development cost and customer acquisition cost, Salah?
No, not exactly. It's depend also on its specific meaning of the development. Sometimes if it's like related, let's say we have a business SaaS business that you need to install some specific hardware on it or to upload something. So in that way, you need to add that cost as its direct cost now. It's a cost of acquiring that customer, because if you didn't install it or you didn't pay like someone to go there and install that, so you need to install it in CAC. But if you're meaning like the research and development of the product and overall, so no, it's an R&D, it's in the other OPEX or other expense, not in the CAC.
Another question on churn. when is the churn rate? When you should worry about the churn rate? What I mean by that, what is the executable churn rate, and when do you start worrying? This is the question that we got.
Okay, so churn rate, it even change from one industry to another. If you want a specific of a SaaS company, between like 10 to 15%, it's average rate. If it's increased more than that, you will start like feeling riskier. So you need like every time to like ask your customer, send NPS for him, find a solution for that to decline it as soon as you possible. So in the end, you need to research the market itself. How is the average or the average churn rate for each industry?
Thus, keep in mind that the more you retain your customer with you, the better it will be to your financials. What do we mean by that? If you can keep the customer for a longer period, that means you can generate more revenue from them over their lifetime, which will have a significant impact on your metrics and financials. Okay, we can move forward.
Okay. So now we understand the metrics and what's the meaning of the metrics. Now we go for the basic of understanding your finance. Well, this is a heavy information, so I think we need Haytham help here. So
No
maybe,
worries. So,
okay.
Sure, I will do that. So basically, there are different financial statements, as you may know by now, that you need to present. The two most important financial statements from a founder point of view are the profit and loss and the cash flow statement. In the profit and loss, basically what you do is you summarize your revenues for the period, be it a month, a quarter, or a year or half year. You summarize your expenses, the direct costs. You summarize your expenses in two categories: the cost of the service or the sales, where you get the gross margin, then your expenses for the period, and you get to the EBITDA, which is the earning before income tax, depreciation, and amortization, which is a very important metric to some of the investors because it represents some kind of the cash flow, the free cash flow. It's not 100% true, but it's an indicator of the free cash flow that you will get. So in a nutshell, your profit and loss is your revenue minus your direct cost to the product, which gives you the gross margin. And that gross margin needs to be positive to have a healthy business. Deducting from it the expenses that you incur, like the rentals, the salaries, any other expenses that relates to the business, to get to the bottom line of the profit and loss. Whereas in the cash flow statement, you don't look at the financials from a pure revenue point of view. You look at the financials. What are the revenues that I will collect or that I'm collecting this period that I collected during the period? Because in the financials, we always look at the past. This is not the forecast. This is the cash flow statement. So I'm looking at the past. What are the collections that I made in the past period? From where did I get these collections? Are they collected from my customers, or did I collect them from non-regular transactions like interest, for example? Where did I pay these cash flows? Did I pay them to pay my suppliers for the regular expenses, or did I pay them to acquire new assets for the company as capital or investment activities? So this is the cash flow statement. It presents the flow, the inflows and outflows of cash that relates to the business. Then we come to the break-even point, where basically, and it's a very crucial point for startups to understand this. What is their break-even point, and when are they going to break even? It's basically when your total revenues equals your total cost. And when we say total cost, we're talking about variable and fixed costs. So it's a very important metric to understand when you will start to break even and also make money. Understanding the break-even point from a quantity point of view, which is dividing your total fixed expenses over the gross margin of the product, it will give you the total quantity or total number of contracts or total services that you need to provide to get to that break-even point. So that's also another metric that is important for you to understand what is the volume? What is the number of transactions that I need, the number of products that I need to sell or services that I need to render in order to reach to the break even and profitability. Now we come to the concept of cash and actual accounting. Most of the founders, I'm pretty much sure that they work based on the cash accounting, cash basis of accounting. What do we mean by that? We record the expense or the income whenever we actually collect the cash or actually pay the cash. Whereas in the accrual basis of the accounting, we record it when it's due, either due for us or due against us. We need to pay it in the future, but we have received the service today. We also rendered the service, but we did not collect the cash. I think I'll give an example here. If you are subscribing in Netflix, for example, and let's say Netflix is charging you on a monthly basis, right? So in the first month, when they charge you the revenue, if you are working on accrual basis or cash basis, then your revenue is the same because it's earned and collected in the same month for Netflix. Okay? Let's assume another scenario whereby Netflix collects in advance and gives you a discount for the whole year. So the subscription for the whole year, let's say the subscription is $10, but if you pay in advance, they will charge you $110. In other words, you collected the whole money in the first month, but your revenue is not 110. Your revenue is basically around $9, which is dividing 110 by 12. Okay, that part of the revenue, which is again 9 point something, this is your revenue that will match the expenses that you will incur during that period. So in month number 1, you will recognize 10. In month number 2, you recognize another 10, and so forth until you get to the last month of the year. Now, what happens to the extra cash that we collected? That's where we said there are other financial parts of the financial statements that we did not list here, which is the balance sheet. You will book this extra cash that you collected as a liability on the company. So let's say month 2, you stop the service. In theory, you should return the cash back to your customer because they did not benefit from the service. Another example, let's say you have a very nice supplier. They will give you the service, and then you will need to pay them the money at the end of the contract. Let's say at the end of the year, you'll pay Netflix $130. So in month 1, you did not collect anything. It does not mean that you don't have any revenue. Okay, so for that purpose, what we do as accountants, we divide the 130 by 12, which gets to around 10.9, whatever is the number, 10.8, and that number is basically recognized in month one as a revenue. In month 2, we will add another 10.8 and so forth until we get all of them. By the month 12, all of the money that we collected will be recognized as revenue. The same applies to expenses. When you pay a rental, you pay it for the full year or for the quarter. It does not mean that you expense it. On cash basis, you will expense all of it immediately when you pay it. On accrual basis, you will expense month 1, 1/3 of it. Month 2, if you're paying for a quarter, month 2, you'll pay the second third, and in the third month, you will pay the third installment. You will recognize the third installment. That's in a nutshell what do we mean by accrual and cash basis of accounting. And that's why we think that it's extremely important to have your accountant very early. Hire an accountant, even a part-time accountant, to do your books from the beginning. This will help you to understand your financials in the right way. When you go and sit with the investors, you will have the details of the history, of your financial performance. So this is in a nutshell what is a P&L, what's a cash flow, and what's the difference between cash accounting and accrual accounting. Okay,
Thanks,
you can
Haytham,
move. I think
very
there
much.
are no questions.
Yeah, it's heavy information for any new startup that don't understand finance, that it's like a hit. That's why I will say the same thing as Haytham said. Please hire an accounting early, because it will help you too much to like keep your book organized and all of that. So after finishing all the accounting stuff, we will move to finance stuff. Now, sometimes or some startup don't like know the difference between the accountant or the finance. For like small summary of it, the accounting will look at the current status and the history. The finance, or the FP&A for short, or something like that, he will look for the future of the company. What will happen to you in the future based on your assumption, your number, and your idea. So I need, of course, to start with the monthly budget. I want you to think about the budget as your reality check. You need to keep it monthly. It's like doing a P&L and cash flow statement that was before we Haytham talk about them. So you need to like project them to the future, but keep it realistic. Why is that? Because that budget will be your plan that will guide you and your team to the future. It will make you work in the same direction, on the same plan. So it will guide you in a specific direction. Next, we go to forecast. Forecast, think about it, it's like an imagination number, or what you want to go in the future in the best way. So maybe you will overestimate something, you will underestimate some cost and all of that, but in the end, always be prepared for the worst. So we always, when we do forecast, we will have many scenarios, like best scenario, worst scenario, and the medium scenario, which will be like a budget for you. And finally, you need also to track your cash. You also keep to monitor it every time to ensure liquidity. Maybe I will go, for example, the same example as Haytham said, Netflix. So let's think about Netflix. But we will reverse it in the opposite way. You have a subscription, but you will pay it at the end of the subscription year or at the end of the service. So as a company, you will need to give that service, and you will pay expense and cost each month, and you will collect your money at the end of the year. So if you like your cash finished at the first 5 months, you can't continue to serve that customer to collect your money. So you will always keep track on your cash flow to ensure that you have liquidity until a specific cash in the future you will have. So those all about finance and forecast and accounting.
So basically,
Yeah.
In a nutshell, when you do the accounting, you're looking at the history, the historical performance of the company. When you look at the budgets and the forecasts, you are looking at the future. You're looking at what are the number of customers that you want to add? What is the churn rate? What are the remaining customers? What's the average revenue per customer, or the average revenue per transaction, and all of this stuff. So you look at the future, then you translate this future profit and loss to a future cash flow. So you know what is the cash that you have at the beginning of the period, then you add to it what are the expenses that you will pay from a cash basis point of view, what are the revenues that you will collect, and so forth. We have one question here. I think it's more on the project side. So how would you structure a financial forecast for a community-led business that plans to monetize through sponsorships and events? So the monetization is happening through sponsorships and events. It's not happening through a customer base or a growth of a customer base. Salah.
Okay. So to project it, you need to look at each sponsor or each project to divide them to a specific project, and you need to do a P&L and cash flow for each one individually. So you need that each sponsor will cover its cost. You will have a good margin in it, and you could then build it in a consolidation to find your overall company budget or forecast. To know specific details for how to do it in budget, it's really complicated, but the trick always, it's in the revenue. In the cost, it's always the same. maybe most of the industry have the same cost, the same type of cost, and the same criteria to calculate and forecast the cost. But in the end, in the revenue, if you like find the trick in the revenue, you could like forecast it based on market research and something like that, and you could put your assumption to calculate that revenue, and everything other than that, it will be easy.
So, for example, in your case, for the forecasting, you need to build your pipeline, and you need to understand what's your success rate from making the pitch to the sponsor, moving to the offer, the proposal, and moving to the contract stage, and then signing the contract. In each stage, these drivers you need to understand as a business. So in order for you to do a proper forecasting. And keep in mind always when you do the forecast, it's not necessarily what you have on hand. It's your prediction, as Salah said, based on the market study and the market need for the services that you provide. Another question is about the scenarios. How accurate is a medium scenario in forecasting? So I think when you do optimistic, pessimistic, and the scenario in the middle, how accurate each one of them should be.
Okay, so let's talk about the medium one at first. The medium, it will be like maybe the same or have some variance from the budget, because it's what you reality is. How much accurate is it? Well, always I said the budget shouldn't be always a 100%. Of course, you will have a variance each time. But the good thing, or the best finance in the market, that he learned from his variance, and each year or each revise of the budget, he keep revising it and smaller, and get the variance small as possible as he can. But to get to a full 100% accuracy, of course, that's impossible, because no one even know how the future. That's why the worst or the optimistic scenario, it's not about accuracy. It's about being prepared. Let's say about the worst, being prepared if the plan didn't go as what we expected. Let's say, okay, we planned that we have a pipeline, let's say, of 1 million, but some economic factor happened that pipeline has disappeared or divided to like half. So do we have a contingency to like survive until everything reverses or not? And the optimistic, what's the best way, or if you take the highest percentage in the market, there would be no accuracy in it, but in the end, you will have like preparation for any risk, and you will have like, let's say, a lick of the honey about the best case scenario. But always, it's not accurate 100%, but you need to plan it in the future so you could get as good as possible in it, or as accurate as possible. So to be like safe and all of that. So I think that's all. You're mute, Haitham. Yeah.
And you can also use these different scenarios for different sides of the business. What I mean by that, when you're talking to your finance team, you normally look at the, this optimistic scenario, because you need to manage your cash flow and your financing. When you talk to your board, you go with the realistic scenario, because you want to achieve these numbers and you want to show growth. But when you talk to your sales, you look at the optimistic scenario, because you want to push them to achieve the higher numbers. So there is no right or wrong with these scenarios. It's basically what's the purpose of the scenario will dictate the numbers of that scenario.
Exactly.
So I think this also comes to the point on which basis can we measure forecast scenarios? If do you mean measure the accuracy of the forecast, or what do you mean by that question? If I may ask. Once you answer me, let's move forward, Salah. We'll see what's the exact question.
Okay. So next we will talk about the investor and the type of fundraising that every founder need to know before go there. Okay, you start your business, you start moving on, but now you don't have cash, or even maybe you have cash, but you want to grow more, to expand more, to open in other country. Maybe you want like to have a new product line inside your own company. So we will have those fundraising types. At start, we will talk about bootstrapping. What is bootstrapping? For short, it's your pocket money that you save, you open in your company with it, you start it, and you rapidly scale by it for your company. Next, we will go to angel investor. Angel investor is like a high value or high income individual. Maybe he's a friend, he's a family, or maybe he's like someone like, you know, that have high income that want to invest, or he is investing in many company to increase his share or diversify his fund. So he have a high net worth money, but we have like disadvantage and an advantage of those type. When you start by bootstrapping, you keep all the control to yourself. No one like take control of your company or guide you to how to manage your company. But when you go to angel invest, he will be like a mentorship to you because he already invested in many companies. He know how business is managed, so maybe he could help you, but he will take from you some equity of the company and some share of the equity. Next, there is a VCs, which called a venture capital. Venture capital is like a high value institute that will pay a high value to your company, but also it will take a high cut of your equity. In general, a startup don't go to VC from the start because it's like a last resort, or at the end life of the startup, we go there to like increase our money and growth even more than what we could do with a specific or self-individual or angel investor. And at the end, we have the private equity. Well, I won't say any more about it. I will only say congratulations to you, founders. You are no longer a startup. You are now a corporate here, because the private equity is a high value institute that private hire company that will do your business, and we will go from startup to corporate. So now you are a big company, maybe you will go IPO, or you even sell your company overall. So here is the end of the way for your journey of your company.
Okay. One thing to mention here, as you go, the more you go in this journey, the more, in terms of control, you will have, for example, you have angel investors, they're not that demanding. They accept your reporting, which you can do on a monthly or quarterly or half yearly maybe, and they wouldn't bother. But if you go to venture capital, then they will ask for board membership. They will ask to be more involved in your business plans, in your growth plans, and so on. They will also ask you for a structured reporting, timely reporting, and it could be on a monthly basis. Last, when you go to the private equity, you're preparing for something different, completely different, either for an exit or you're planning for an IPO. And then here you have a lot of compliance, a lot of structured reporting, financial controls, and so on. So when you think of accounting and finance, if you build your reporting and structures from the beginning correctly, including the policies at one point of time, the policies, procedures, and the controls, this will help you to move in this journey faster and seamlessly as well. There are a few questions here about at which stage should one approach an angel investor?
Okay, so let's have an example about it. You started your company, maybe you have some saving that you started of it. We always go to angel investor before from like 3 to 6 months, because the operation, the communication, the agreement will take maybe 1 to 2 months. So you don't want to get to a way or to time that there is no cash that you could continue. So you need to make ahead of time and contact them between 3 to 6 months, based on how mature that the angel investor or how much value he have in the market or in the industry.
Okay. And the other question, how much equity angel investor ask?
It's not about how much, it's about how much money you want. It will be like negotiation. In the end, you could think about it, you are the sell side, that you will sell cut of your company, and he's the buy side. So he will try to buy it at the lowest price, and you will need to sell it at the highest price. So it's like a negotiation, how much you want to give him from your company, on what percentage, And in the end, it depends on the valuation of your company. If your company is still in early stages, have no valuation, the negotiation would be like without any financial or statistic vision. But if you maybe started, let's say, after 1 year running, so you could do a valuation for your company based on your revenue, on your value, or your annual ACV.
Okay. And which scenario do you recommend, an incubator or bootstrapping? Which one is better, to go for incubation or bootstrapping?
Okay. Well, both of them have a disadvantage and advantage. Bootstrapping has its advantage that it's your own money, your pocket money. You will keep control of the company alone. You don't have anyone to share with you. In the other way, they will keep in the other option, they will start maybe challenging you with your plan, with your way on how you to manage your company. So it depends on how much mature you are. Do you know how to manage? Do you understand finance overall? You could go bootstrapping if that, yes. If not, you could go any other options.
And bootstrapping versus angel investors versus venture capital?
It's still the same.
Yeah.
Any company at the start will start maybe as a bootstrapping if you have a saving money. Some like individual or founder don't have even those pocket money. So by default, he will go to angel investor. Venture capital, well, I prefer to keep it at the end because it's have really complicated. And even for them, they won't invest in any company that wasn't running for some times and have a specific valuation, unless your company have a big idea that will like make some big bang in the environment or in the market. So it's not
One
that
last
easy.
question. One last question on the subject. Are there companies that manage on bootstrapping only? The answer is yes. There is one company in
Yes.
the States that I know of. They have some very niche product, and it's only the founder money that is invested. They're $1 billion revenue company, and it's all financed through they're profitable as well through the bootstrapping, through the initial founder, and they have only one founder. So you can imagine the worthiness of this company. Okay. So can you move so we don't I think we are it's 5:30 now. We have a couple of slides remaining. Are
Yeah.
you fine if we overrun the time?
So I've just asked in the chat if it's okay. And I think some of them may drop off because they have other meetings.
Okay.
But let's try and be quick so that whoever can
Yeah,
catch
well,
the
sure. We
connection,
will do
and then
that.
we can
Yeah.
come back to the Q&A
Yes.
once we finish the slide. So
Yeah, sure.
Okay. So maybe we'll move faster. It's okay. Okay. So after knowing the type of fundraising, we will talk about the instrument of funding. Okay, you know every type of fundraising now, but what type of instrument that you want to approach your VC or angel or even your private equity investor? At start, we have the equity round. For short, what's the equity round? It's like you only sell a couple of your company, you take that cut and you give an equity or capital share in your company to that individual. This will lead to dilution, which will decrease your ownership in that company. Next, we have a safe note. Safe note is like a simple agreement, but you take the fund now, but you change the ownership of equity in the future. So you will keep your management, you will keep your share at this moment, and in the future he has the option, or he will simply agree to change his notes to an equity, so he will have a share. We will have a quick example about it. Let's say you have a valuation for your company of 2 million and you have a 1 million share. So the cost per share would be $2. You approach a safe note and he give you 200,000. So when you divide the $200,000 in amount in value by the 2 per share, you will have a 100 share as a new share for that individual. So in a total, you will have a 1,100,000 share. in total. So we will talk about your share. You already have a 1 million of 1.1 million, which will yield or decline your ownership in that company to 90.9. Next, we have a convertible note. It's really the same as the safe note, but have an interest. So we will talk about it in the same example, but the 200 now have a 5% interest, which will be after 1 year a 210. So instead of dividing the 200 that you initiate the amount that you receive by 2, you will divide the 210, which is the future amount or the total note amount with your interest rate. So it will yield 105,000 share. So the new share would be 1,105,000 share. That will decline your ownership to 90.5. So the decline is more than the safe note. The safe note is always friendly and flexible more, but sometimes you don't find a safe note that, or some individual that would give you a safe note and you would move to a convertible notes. Next, we will talk about venture capital. Venture capital is like a loan, but have a warranty, which is an option that in the future, he may change that to an equity and he may not. In the end, it's like a loan, so it's an amount that it needs to be repaid in the future. That would yield a less dilution from the safe note and the convertible note, even from an equity round, because in the end, if he didn't like change it and use his option to change it, you will keep your 100% ownership of that company, but you need to repay his amount, and sometimes it would be with an interest. And finally, we move to the bank loans, which every loan that you approach a commercial bank or an investment bank, sometimes it's a last resolution for it, but it also have some criteria that he will need collateral for it, he will need a guarantee for it, because that's what the bank asks in the end. So always a company like keep that option to the last stage, because you need to have like an asset heavy startup, or some company could approach it from the start if it have like a high value assets of its company, which is the capex. So those are the instruments for the company. Next, we will talk about those investors. You approach them, you agree with them about the instrument that you want to use, but what they are looking for, what they need from you. So in majority, they would need 5 things from you. At first, they will look about your founding team. What's the core team that you started with? What are they full-time? Are you dedicated to it? Their passion, their resume. So you need like to sell yourself. It's not like only about selling your company. You need to sell yourself to sell your company. Moving after that, you need to understand your market size. You sell a specific product. There is a TAM, which is the total addressable market. It's the overall client, or the overall people that you could sell that client. But in the end, of course, you can't like serve them all. So you will have a percentage or a cut from that TAM, which is the SAM. It's how much or what realistically you could serve from the total market that you are in. And next, you need to have a unique value proposition for your product. What makes you different? Are you better or not? What's unique in your product overall? That will lead us to our competitive. You need to understand your competitive, their strength, their advantage, disadvantage, their threat, and the opportunity that you could have in that competitive landscape. And finally, you need to have a business model, which for a short, it's the pathway to your profitability. Because in the end, when you want to talk about to investor, he will need to know when you will get profitable. Okay, I will put some money with you, but when I will get them back. So the investor always want to see how you scale efficiency, not just how fast you burn money. So you need always to be ready. And in short, after all of that, what is your story? All of those criteria, they shorten your story. So when you approach the investor, he will ask about something called a pitch deck. So you need to have it ready. What's a pitch deck? It's a presentation, which is a small presentation that talk about the 5 criteria that we covered, which your vision, market knowledge, progress, business model, your team strength, and funding request. I also love this example that every time when I talk to someone, I talk about it. Like, consider yourself walking in the mall and you enter an elevator. And by coincidence, you find some investor or heavy one that could invest in your money. You only have from 6 to 10 seconds to let him or convince him to invest in your company. So you need to be ready for that. That's a pitch deck. I always call it an elevator pitch. So always be ready, practice a summary of your pitch deck, understand your company, your team, your market, and all of those things. So you will be ready when any chance that happen in the future. So here we cover everything about finance, about the metrics and unit economic that you need to understand, and the investment from its type to instrument, about what they want. So now we will share some of our experience, me and Haytham, about the top founder mistakes that every founder or major of the founder have them in their company. So if you could move with them, Haytham.
Sure. So one of the key things that you need to avoid is mixing your personal and business finance. What do we mean by that? What do we mean by that? Is basically, when you have a personal credit card, try as much as you can not to use it for business. Or when you have a business credit card, don't use it for personal expenses. A lot of the startups, they face a lot of troubles when it comes to due diligence, and the accountant comes and see a lot of personal expenses embedded or as part of the startup cost. It will trigger a confidence issue with anybody who's doing the due diligence. So please always make sure that you separate your personal finance from the startup finance. The other mistake is basically overestimating your revenues or underestimating your costs, which will lead to a higher burn rate or net burn rate, which will make you suffer very soon, and you burn your cash that you have on your hand. So always look at your numbers, look at the revenues, look at the expenses, and always amend your forecast based on what's happening month to month in your business. The other thing when it comes to investors, dilution of the valuation of your company, the dilution of your shares or the valuation of your company, always keep an accountant who understands finance beside you, because numbers become sometimes very tricky. What is the money that you want to invest? Is this pre-money valuation, post-money valuation? What is the percentage that we are after? What is the valuation itself? So all of this stuff, be ready and be prepared. Consult with somebody who has been through this, who knows how to basically to advise you on these negotiation tactics, if I may say. Last but not least, and the reason we keep it in red, it's business. You see, this is not accounting at all. It's understanding your customer, understanding your target customer, understanding your business drivers, your revenue drivers. What brings your customer to you? What's your unique value proposition that you're offering to the customer? This is very important for any business to succeed, and especially for startups. So you need to understand who's your customer. You need to understand the pain of your customer. And once I read that the successful basically startups, when you have the CEO or the owner of the company or the founders of the startup basically involved in the customer complaints. I don't mean by that answering the customer complaints, but they review what are the customer complaints, what customers like about the company so they can build on it, and what customers don't like about the company or the startup, and then you can avoid it or make the needed rectifications for these feedbacks. This is very critical for the success of the business. Understand your target, understand your customer is key before any finance numbers.
Thanks a
Can
lot,
we move?
Haitham.
I think
So
we have
in the
one
end,
more. Yeah.
I
Go ahead.
would say a final takeaway, and I want everyone to remember these things. Always know your number, even at early stages. Track, forecast, and adjust. Speak investor language. It builds the trust with them. Build finance habit now, not after you raise money. So I think that's all what we could give you. I hope everyone have fun. I don't know, maybe Haitham have fun with us today. So I don't know if we have any time to have a Q&A. I don't know.
One question is how to get venture debt. It's just a recent question. There are a lot of compliments. I am not reading them, Salah, but how to get a venture debt.
Okay, the venture debt. Venture debt, not all country have them at first. Maybe in some mature company have them, but from where we could get them, you get them even from banks or sometimes from company that is related to bank, like investment company that give that venture debt for you. I don't know, every country have different company, different bank criteria, but not all country have this option.
Should the company start with finance software program immediately? And if yes, what is the simple start? Or do we stick to Excel?
Okay, so if I understand correctly about system, you mean financial system or a system that help you for sales and everything. Well, for a startup, it's not the best way to go for the higher expense or the best package in the world, because in the end, you still a startup. You have a specific amount of money. You need to start small. As you grow, and even you could do it on Excel or dashboard on Excel, Google Sheets, you could use all those things. Use some AI even, if you could, ChatGPT, all of those criteria. But in the end, when you grow, when you volume of your sales is increasing, you need to increase those things and to have a heavier system, more complex system, so you could even track your business, because it's complicated.
Well, we talked about customer churn, right? Following the churn, following the clients, understanding what they need, etc. So at a certain point, it very quickly it becomes too much information, right? To just track in Excel, and
Yeah.
there's kind of and I know a lot of startups are struggling with this, right? So as you said, of course, you don't start with an Oracle suite, but you might start with something simple called HubSpot, or right. So
True.
it's just from a finance perspective, what would be a good kind of start that is low in cost, but still would kind of help you track?
Okay, if I may answer this question. Yes. So it depends on the complexity of the business. If you are in a fast-moving business where you have plenty of orders, too many orders that you need to reconcile, you have in and out products, you're having different suppliers in different places, then invest in your ERP, because the later you invest in your ERP, that means you're losing money and you're losing the visibility of your customers. But if you are in a slow pace business, there are a lot of, by the way, affordable ERPs that could be around $30 or $20 a month. I can name a few for you, like Zoho, QuickBooks. You can subscribe online. They're very simple to use. They're available. Anyway, there are plenty of packages. You don't need to go for tier one, but understand your business, understand the volumes, understand the risk, because if you miss 1,000 transactions with $10 each one, that means you're losing $10,000 every day, which could make or break the business for you. So please understand your business. Your accountant definitely will help you to select the right package.
Good. Cicely, I think we're at the point of saying thank you, or do we have time for some questions?
No, so when you sign off, everyone will get a poll. So make sure you answer that so that we get the feedback to keep improving. Very practical insights, I thought, from Salah and Haitham. And I think you came in and questioned certain things and put in scenarios for people to sort of relate and understand. Thought it was really practical and valuable. There's a lot of good feedback in chat as well.
Yeah, I saw it.
Yeah. So thank you to both of you.
Thank you very much.
We're here to help the founders. So stay in touch, follow our channels, Thai Dubai on all our social channels, Instagram, LinkedIn, Facebook is where we are most active. Talk to us and we'll keep doing things together. And have a
Cecily, are you
wonderful-
going to share the presentation with the
Is that
attendees?
okay? So
Yeah, just convert it to
Yeah,
PDF and you share it with everybody. That's fine with us.
Great.
yeah,
Great.
so we can, for whoever joined in, we can send them a Mars email.
Please do. Please do that. Even if people, just register, you can send it to them. It's okay.
Okay.
Thank you so
That's
much. And
fine.
I've learned a lot, so thank you both for taking
Thank
the
you very
time.
much. Thank you.
Thank you very
Same
much.
here.
Thank
Bye.
you.